You see the candlestick patterns right in front of you. I mean, you look at the charts, you recognize the shapes, you've probably memorized the names from, a dozen different textbooks. Right, or endless online tutorials. Exactly, but you don't really understand what they mean. And because you don't actually understand the language being spoken on that screen, your trades still fail. It's the single most common and without a doubt, the most painful reality for anyone stepping into the financial markets. Yeah, it really is. It's this illusion of knowledge, right? It just masks a fundamental misunderstanding of how market mechanics actually work. I want you to picture this scenario because if you are listening to us right now, you have almost certainly lived it. I know I have. Oh, absolutely. You're sitting in a dimly lit room. The only real light in the room is just that cold, flickering glow of your monitor, just staring at the screen. Right. You are staring at an xauusd chart, so gold against the US dollar, and you're watching those red and green rectangles move. They tick up, they tick down. It's almost, predatory in a way. It feels very predatory when you don't know what you're looking at. Yeah. And then you identify what you think is a textbook pattern. You see it forming live. Maybe it's a hammer at the bottom of a drop, or, a massive bullish engulfing candle. And you feel that physical reaction. Yes. That sharp tightening in your chest. Your heart rate starts to climb. You feel the hesitation, right? That heavy doubt holding your hand back from the mouse. But the fear of missing out, the FOMO, it just pushes you over the edge. It pushes you right over. You finally push through that anxiety and you click buy. And then the trap springs. Almost instantly, the market reverses. You just watch, in real time, completely paralyzed, as the price aggressively moves in the exact opposite direction. It wipes out your position, spikes it out, triggers your stop loss, and just like that, the money is gone. And your confidence just drains away, leaving that hollow feeling in your stomach. It's exactly what you see on the screen, but it feels like a language you simply cannot translate. Think back to the last time you took a trade that looked utterly perfect, only to have it blow up in your face within minutes. If you're nodding your head right now, if you've ever felt lost looking at candlestick patterns, comment why. So I know I'm speaking to the right people. Because that feeling of being lost, that feeling of the market specifically targeting you, it is not a personal failure. It feels personal, though. It always feels personal. But it's a structural failure. You have been taught to read the market the entirely wrong way. So that brings us to the mission of our deep dive today. We are going to fundamentally and permanently dismantle that confusion. We've gathered a stack of the most advanced professional trading sources from the 2026 landscape. We are focusing heavily on raw price action, the underlying trading psychology, and the mechanics of smart money concepts. Basically, how the massive institutions actually operate. Exactly, how the real money moves. And to be clear, right from the start, we are going to strip away that amateur habit of blindly memorizing geometric shapes. Precisely. Our singular goal over this session is to replace your fear and that hesitation with a calm, authoritative understanding of institutional intent. We're going to look specifically at the highly volatile gold market. Yes, xauusd, and we are going to learn to read the silent narrative of the order book. Now, we need to establish right at the top that today's session is a serious, no-nonsense masterclass. If you're looking for hype, or a magic indicator, or some upbeat banter, this isn't it. No, this is about a deep, practical, mechanical transformation of how you view the chart. Because to stop losing trades, we have to completely stop looking at candlesticks as static images. They aren't templates in a textbook. We have to start viewing them as live, bloody battlegrounds. I love that visual. So let's get into section 1, candlestick psychology. Right. A candlestick is not merely a record of a price. That is entirely surface-level thinking, which is where beginners get stuck. Exactly. A candlestick is actually a high-resolution snapshot of an emotional and financial struggle between buyers and sellers, all within a specific window of time. So, to stop bleeding capital, we have to deconstruct the anatomy of that battle. Yes, every single candle is built from 4 raw data points. Yep, you have the open, the high, the low, and the close, the OHLC. And together, they tell a continuous narrative. A narrative of conviction, of exhaustion, or, very often, of outright deception. Let's slow down and really unpack that anatomy. I want to start with the open, because when a beginner looks at a candle, they barely even register where it opened. It's an afterthought to them. Right, but what is actually happening at that exact millisecond when a new candle begins? Well, the open is essentially the starting bell of the round. It is the exact price point where the market participants agreed to begin doing business for that specific time period. Whether it's a 5-minute chart or a daily chart, doesn't matter the time frame. The open represents the baseline sentiment at that exact moment. But you know, the open alone doesn't tell us much without the ensuing struggle. The real story begins the moment price moves away from that open. Okay, so price moves and it leaves behind a shape. Let's talk about the body of the candle first. That thick, colored, rectangular space between the open and the close. The part everyone stares at. Yeah, I mean, I used to just see red or green and assume I knew exactly who was in charge. And that assumption is exactly what Wall Street algorithms rely on to take your money. The body is the primary indicator of momentum and dominance. But you have to read its size, not just its color. The size tells the real story. Exactly. The body represents the actual hard-fought territory gained and held by one side. If you see a strong, large body, it means one side had absolute totalitarian control of the tape. So from the moment that time period opened to the moment it closed, the buyers, if it's a bullish candle, obviously pushed the price with relentless conviction. Right. They didn't just move the price, they displaced the sellers entirely. Displaced. That's a great way to put it. It is the perfect word for it. A massive body represents an imbalance in the market. It means the buying volume was so overwhelming that the sellers couldn't even slow it down. And this kind of movement, that's rarely caused by just a bunch of retail traders sitting at home, right? Very rarely. A large, full-bodied candle is the visual footprint of institutional volume. It is a massive block order being executed. Conversely, what if we have a very small body, or a doji, where the open and close are nearly identical? What does that tell you mechanically? Well, if the body is the territory held, a small body means nobody held any territory. It represents hesitation, a stalemate. Exactly. A state of temporary equilibrium. The buyers tried to push, the sellers tried to push, but neither side had the capital or the conviction to establish dominance. The auction ended in a tie. So that covers the body. But then we have the wicks, those thin lines sticking out from the top or bottom of that colored rectangle. Some people call them shadows or tails. Yeah. And when I first started trading, I completely ignored the wicks. I thought, oh, the price didn't stay there, so it doesn't matter. Ignoring the wick is a fatal error. Particularly for a gold trader, the wicks are, arguably, more important than the body. Really? More important? Yes, because the wicks are your most vital clues. They represent the rejection zones. A wick marks the exact territory where price attempted to venture, but was violently and aggressively refused by counterpressure. Let's visualize this mechanically. Say we have a long upper wick. What actually happened in the order book to create that thin line? Okay, let's walk through it, tick by tick. The market opens. The buyers flood in, maybe fueled by optimism or some positive news event. They are hitting the Buy at Market button. The price surges higher and higher. So at this moment, to the untrained eye, It looked like a massive, dominant green candle is forming. Right. Retail traders see this momentum. They get FOMO, the fear of missing out, and they jump in, buying near the very top of that move. But then they hit a ceiling. They don't just hit a ceiling, they hit a wall of institutional limit sell orders. A wall? A massive wall. An institution, a major bank, has been waiting patiently for the price to reach this specific high valuation. The moment the price hits their zone, their massive sell orders are triggered automatically. The retail buying pressure is instantly absorbed. It's overwhelmed by the institutional selling pressure, and the market is slammed back down before the session ends. And all that is left behind to show for that massive upward push is just a thin line at the top of the candle, the wick. Yes, that wick represents what professional traders call unaccepted value. The market briefly explored that high price, tested it, and aggressively rejected it. But more importantly, think about the psychology of that wick. It is a visual graveyard. That is exactly what it is. 1. It's a footprint of trapped retail traders who bought at the absolute top, expecting the green candle to continue, and are now sitting in massive drawdown, just sweating, hoping the price comes back. It is a terrifying but incredibly clear way to look at it. The wick is a graveyard of trapped traders. So we have the open, the body representing the held territory, the wicks representing the rejected territory. And that brings us to the final piece, the close. The close is the final verdict of the battle. It is the most critical piece of data on the entire chart. Why is it the most critical? Because it reveals where the market participants collectively agreed value should reside when the clock finally ran out. Everything else during the formation of that candle is just noise and negotiation. The close is the contract being signed. I see beginners doing this all the time. They react to the price moving while the candle is still alive, constantly. The 4-hour candle has 2 hours left on the clock. It's pushing up. It looks huge, so they buy. Then, in the last 30 minutes, it crashes down and closes as a tiny red body with a massive upper wick. Because amateurs trade the formation, professionals trade the close. Until that candle closes, the story isn't finished. The close is the only point of certainty you have. And when we look at the xauusd market specifically, the environment we are trading in right now is unforgiving. Unforgiving is an understatement. We're looking at gold experiencing massive daily price swings. We're talking about $150 to $200 of movement from high to low on a given day. The volatility is breathtaking. The volatility is extreme, but it is also highly structured if you understand the mechanics beneath it. Gold is not a random number generator. It feels random to a beginner. Of course it does. In the gold market, you will often see incredibly fast, sudden spikes in price. These are emotional market reactions, driven by sheer panic or sheer greed, usually in response to macroeconomic news, inflation data, or geopolitical instability. But then you have the wicks, the long, dramatic wicks on a gold chart. The long wicks we see in gold are almost never accidental. They are not random fluctuations. What are they, then? They are deliberate, calculated liquidity manipulations executed by smart money. The central banks, the sovereign wealth funds, the massive hedge funds. Exactly, yeah. Because of gold's liquidity profile, these institutions use those rapid wicks to trigger the stop losses of retail traders. They engineer the wick. They engineer it to gather the liquidity they mathematically require to execute their own massive orders. Okay, let's stop and really unpack this, because this is a massive paradigm shift. A beginner looks at a massive green candle with a huge wick at the top. They see the color green. They assume green means the buyers won. Green is a definitive buy signal in every beginner tutorial out there. But aren't you saying that if that green candle has a massive wick at the top, the color itself is actually lying to us? That is precisely what I'm saying. Believing that color equals directional certainty is the deadliest trap you can fall into. So, the green is fake? A green candle with a massive upper wick means the buyers failed entirely. The color may technically be green because it closed 1 penny above where it opened, but the psychology of that candle is overwhelmingly, aggressively bearish. Because the sellers took absolute control of the top of that move, and they forced the price down with immense power. So if you buy based purely on the fact that the body is green, ignoring the story the wick is telling you, if you do that, you are stepping willingly, blindly, right into the trap the institutions just spent hours setting for you. You are becoming their exit liquidity. Wow. Think about what that means for your own trades. Think about how many times you've got a green candle only to be crushed by the subsequent drop. If this part changed how you see the market, comment "real" down below. We have to move past the surface level of shapes and colors. You really do. Now that we understand the anatomy of a single candle's battle, the psychology of the OHLC, we must look at how these single battles link together to form patterns. And more importantly, we need to understand why memorizing these patterns blindly from a cheat sheet is a guaranteed recipe for failure. So let's talk about the real meaning of candlestick patterns. Right, what is the core issue here? The core issue plaguing the retail trading industry is how education is packaged. Retail traders are taught that candlestick patterns are signals, like a green light at an intersection. Exactly. They believe a pattern has a magical predictive power over the future. They do not. If they aren't signals, what are they? A pattern is simply a visual footprint of repeated human behavior and institutional order flow. Human psychology, the cycle of fear, greed, hope, and panic, it hasn't changed in hundreds of years. And neither have the fundamental mechanics of how massive amounts of money move through an order book. Exactly. When we look at the classic patterns, what we call the big three, we are not looking for a shape. We are looking for the story of the order flow behind the shape. Let's analyze these big three, but let's do it through this new mechanical lens. Let's start with the engulfing pattern. Okay, 1. Visually, for a beginner, it is just a smaller candle followed by a much larger candle of the opposite color that completely swallows or engulfs the previous one. Visually, yes. But behaviorally, mechanically, an engulfing pattern is a violent shift in control. Give me an example. Let's use a bullish engulfing scenario. The market is dropping. The sellers are in control. They print a red candle. The next candle opens, and the sellers try to push the price even lower. Makes sense. But suddenly, they run into a wall of demand. And it's not just a little demand. It is demand so massive, so overwhelming, that the buyers don't just stop the descent, they aggressively reverse the price. They completely reclaim all the territory the sellers fought for in the previous session, and then some. It's an absolute rout. It's displacement. It is absolute displacement. You do not get a true engulfing candle on a high time frame just because a few day traders decided to buy gold, right? It is the visual manifestation of a massive institutional buy order stepping into the market and completely absorbing and overwhelming the retail selling pressure. So when I see an engulfing pattern, I shouldn't just think buy. I should think a major player just stepped onto the field and completely changed the momentum. That is the exact right mindset. Next, let's look at the pin bar. Some people call it a hammer, or a shooting star, or a kangaroo tail. It goes by many names. It's that single candle we discussed earlier, a very long wick, and a tiny body, usually sitting at one extreme end of the candle. Every textbook says if you see a hammer at the bottom of a trend, buy it. And that textbook advice is exactly why 90% of retail traders lose money. Why is that? Because the pin bar, when viewed mechanically, is the ultimate footprint of deception. It is a trap. Break that down for us. Why is it deceptive? Let's look at the actual physics of what creates that hammer shape. Imagine a solid price floor, a major support level that everyone in the retail world is watching. Okay, got it. The price is dropping toward it. Retail traders see the drop, they panic, or their trailing stop losses get triggered, so they sell. The momentum is heavy. The price punches right through the floor. And when a support level breaks, breakout traders jump in to short the market, expecting it to plummet further. Exactly. So you have a massive influx of retail sell orders below that floor. That creates the bottom of that long wick. But here is the critical question. Who is buying all those sell orders? The smart money. The smart money. The institutions. They literally need all those retail sell orders to fill their massive buy orders without causing severe slippage. So they absorb all that panic selling and all those breakout shorts. And once they have absorbed it all, the selling pressure literally vanishes from the order book because they bought it all. Yes, as 12. The institutions then aggressively drive the price back up above the floor before the candle closes, leaving behind that long wick. Leaving behind a wick that is literally a map of where retail traders were trapped into selling the absolute bottom. Wow. In gold, a pin bar often forms when the price sweeps just below an old low or sweeps just above an old high. It is a liquidity grab. They push the price into the stop losses, fill their orders, and reverse the market. So, a hammer isn't just a signal to buy. It's evidence that the institutions just finished trapping the late sellers. Exactly. This completely changes how you look at the chart. It's not just shapes. It's a record of who is getting trapped where. That's the only way you should look at it. Let's move to the third major pattern, the doji, a candle with almost no body, just a cross or a plus sign, maybe with wicks on both ends. The doji represents complete indecision. It is the tipping point in the battle. Let's look at the order book for this one. The doji forms because every time a market buy order hits the tape and tries to push the price up, there is a limit sell order perfectly absorbing it, and vice versa. Right. And every time a market sell order hits the tape, a limit buy order absorbs it. The buyers and sellers fought a bitter war for that entire session, and it ended in a mathematically perfect tie. It's like two massive sumo wrestlers locked in the center of the ring, neither giving an inch. That is a very apt analogy. The doji is the silence before the storm. It shows extreme tension. Do we see this often in gold? Very often. In the gold market, you will frequently see dojis appearing on the daily or 4-hour charts right before a major macroeconomic release, like NFP. Like the Thursday before the U.S. non-farm payrolls report on Friday, the institutions aren't going to take massive directional bets right before the data drops. They're just waiting, sitting on their hands, deploying algorithms just to keep the market in a tight equilibrium. They are waiting for the fundamental catalyst to provide the liquidity for the next major directional move. But here is where beginners get completely destroyed. They memorize these three shapes, the engulfing, the pin bar, the doji. They print out a cheat sheet, tape it to their monitor. I see it a million times. They see a hammer form, and they immediately click buy. But our sources make it abundantly clear that there is a massive context fallacy at play here. This context fallacy is huge. This is perhaps the most important concept we will discuss today. The exact same pattern means two completely diametrically opposed things depending entirely on its location on the chart. Same shape, different meaning. Yes, a pattern in a random location is just market noise. It means absolutely nothing. Give me an example of that. Okay, if you see a beautiful textbook hammer form right in the middle of a choppy, sideways, dead volume consolidation range on a Tuesday afternoon. It has zero predictive power. Just random algorithmic ping-pong. Exactly. Furthermore, think about a hammer forming at the very top of a massive multi-week uptrend. Well, a hammer is supposed to be bullish, right? So, does it mean the trend is going to explode even higher? No. If a hammer forms at the absolute top of an uptrend, it is not a hammer at all. In traditional terminology, it is called a hanging man. It signifies weakness, not strength. Wait, how can the exact same shape mean strength at the bottom, but weakness at the top? Think about the mechanics we just discussed. We are at the top of a massive rally. The price drops sharply, creating the long wick down, and then the buyers push it back up to close near the open. Okay, yeah. Why is that weak? Because the sellers were able to easily crash the market in the first place. Yes, the buyers recovered the price, for now, but the fact that such a deep drop could occur shows that the bullish momentum is exhausted. The heavy selling pressure has finally arrived at the top. The buyers barely survived the round. Memorizing the shape of the hammer without understanding that location dictates its meaning, that is exactly why retail traders fail. This brings us to the most critical realization of this entire deep dive. Context over everything. Location, location, location. Without context, you have nothing. If a candlestick pattern in a random spot is just algorithmic noise, we must define exactly where we should be looking. We are looking exclusively for high-value key levels. These are the critical structural zones on the chart, where patterns actually carry statistical weight, because these zones represent areas of historical, institutional decision-making. Exactly. We only care about the battle if it is taking place on important terrain. Knowledge in trading is completely useless unless it is applied critically. Every single time you open your charting software, before you look for a single pattern, you should be asking yourself, where is the liquidity resting right now? Who is currently trapped in a bad position? Has the institutional trap already been sprung, or is it about to happen? We want to leave you with a final provocative thought. Institutional banks, massive hedge funds, and sophisticated algorithms have built multi-billion-dollar strategies entirely around predicting exactly where you, the retail trader, are going to place your stop loss. They know the textbooks you read. They know the patterns you memorized. So what does that mean for your very next trade? Are you blindly placing your safety net exactly where the engineers have planned the demolition? Take a long, hard look at your charts today and ask yourself, who is really in control?